Let's ask our headliner today, Tom Lee. He's FundStrat's head of research, chief investment officer, also a CNBC contributor. And it's good to have you back. Welcome.
Great to see you, Scott.
Told us that you thought the bottom was in and that new highs were in reach. Now here we are. Now what?
I know this is going to sound counter to what the viewers might think, but I think the stock market is in a better position today than earlier this year when it made its all-time high. Because one, we're now seeing that the U.S. stock market can handle a surge in oil while it hurts other countries. We've seen earnings go up, so we now feel comfortable that the war is actually stimulating the economy. And the third is, I know I've talked before about inflation shocks, but we've been looking back at the history of oil spikes, and the impact on core is less than we thought. So I think there may be less of an inflation shock coming. So I think stocks can go back to that 7,300, which is our base case for this year in our three-phase market, before we might see a larger drawdown.
Well, I hear you essentially saying that the U.S., in some respects, as a result of this war, is the best house in a now more uncertain neighborhood.
That's right. This is the seventh black swan now thrown on investors since 2020. And now we've seen that the U.S. can handle a Middle East catastrophe, one where the strait is closed and oil's not available. The U.S. economy is still operating while other countries are talking about shutdowns and factories closing.
You don't feel in any way, or you're not concerned that you may be complacent to the risks that are still out there because of the war?
There are tail risks. I think that the size of the tail has shrunk, tail meaning a downside risk. And I do think that there's a lot of folks who are credibly pointing out that the shock could still hit the shore in the U.S. because of things like helium and other commodities. So we are watching that, Scott, but I'd also say that we could have a positive tail risk, which is if we can find a lasting ceasefire, then whatever shock hits the shores is so short in effect that it won't hurt our base case.
The NASDAQ is trying for its 11th straight positive day. It'd be the longest streak since November of 2021. There are those who believe, like JP Morgan does, that if the next leg of the rally is going to be strong, tech is going to have to lead. Do you agree with that call?
Yeah, we do. I think that it's still useful for people to look at what has outperformed since the war started. And, number one has been Ethereum and Bitcoin, which are crypto, but they're highly correlated to tech. Of course, there's energy stocks, but then it's led by tech, and the Mag 7, and even the software. So I think that JP Morgan's correct. I think tech is growth when people are worried about growth. And of course, it's also been the most under-owned group because that's the group people were selling.
Well, part of the call is that you're going to get the best earnings growth from tech. There are more notes about that today, while at the same time, valuations have fallen. So these stocks in some people's eyes aren't as pricey as they used to be and look even more attractive because earnings growth estimates are solid, if not increasing.
That sounds right, Scott. These companies have true moats. They've grown earnings consistently faster than the S&P. I think they're going to be one of the winners around AI. And you're right. To buy them at a market multiple means that 5 years from now, I think people are going to be surprised that they could buy them so cheaply.
7,002.28. That's the number we need to watch. We're not that far away. It's pretty remarkable to say that, given where we were in the not too distant past. That's for sure. NASDAQ is up near 1%. Dow's giving back about a 0.5%. But, Joe, it's a resilient market, and we have said that the tide had turned, and this market just wants to go up. And it's going to hit these records. It's just a matter of when, not if. I think that is, you don't need to be a genius to suggest that. We are so close.
And I think the question is, does the market break out above that new all-time high and raise the range of what previously had been 6,300 to 7,000.
Answer your own question.
So as long as what I have been telling you over the last several days continues to be the formula where growth is leading the charge, then I think, yes, in fact, we will be able to advance beyond that level and establish a higher range. Okay. It is growth that is taking us higher. Today, the formation is not as strong as I would like it to be. Today, it is about the laggards. It's about the growth laggards. If you look at the mega caps, yes, you have Apple higher, but it's Tesla up 7%. It is along those lines as well. Microsoft leading the charge higher. It is software that's taking the market higher. It's not really semiconductors as much as it has been the last several days, but it's growth, it's technology. That's the leadership. It's not S&P equal weight.
Okay.
It's not S&P value. Stop looking at my earpiece, which is falling out of my corner. It's falling out.
Distracting. How am I supposed to listen to what you're saying when your earpiece is like dangling out there?
It's not S&P equal weight. It is growth right now.
Do people see that? I mean, they're distracted.
It staggered me for a second. It popped out. I lost my train of thought.
Yeah. Well, you learn how to work with that thing. So, Joe's premise is what is being talked about today on the street. It's like, yeah, we know we're going to hit these new highs, Carrie. It's like, then what? After the new high is reached, in which JP Morgan addresses that and says, we think markets will begin with an everything rally, similar to that seen on March 31st and April 8th, with investors chasing sectors, subsectors hit the most. Look for a return to all-time highs across the major indices. So that means not just the S&P, like we're going there for everything. But after that, we think a return to fundamentals is warranted. If so, the next stage of the rally depends on the Mag 7, mega cap tech retaking leadership. That's exactly the point that Joe just made. But that would be different from the makeup of the market before the war started. So
Correct.
Do you agree with both Joe and what JP Morgan says?
Yeah, I agree with that for this reason alone. The market had become sort of obsessed with the anti-Mag 7 trade and with the 493 or the halo trade, and that ran its course nicely, but got to the point where the multiples were 30 times if you looked at a group of industrials versus 20 times next year earning for the growth stocks or the mag stocks or the semis, who have much higher growth rate for this year and next year. So what we're going to see is all these big tech names are going to report earnings in the next few weeks, and we would expect that they will have good earnings. They don't need the tanker to get through the Strait of Hormuz. All they need is for you to be sitting on your phone and be reading and watching and buying on Amazon or Meta or Google, and that's what drives those companies. They should have good numbers, and they are 35+% of the market. When they move, the market will move, and we need to see that, and it's good that they have led this rally upward.
So the reason why there's optimism, Liz, around this space is kind of obvious: earnings growth. And HSBC says you're going to get a banner earnings season. Tech as usual leading the growth, which I think people already know. And then Piper Sandler talks about valuations have fallen, but earnings are at record highs. So you're getting the same earnings growth that you expected before, and now you're getting the stocks cheaper. They're all in. The tech sector on January 1st was 26.5. Today it's 23. Now that's today after this huge run that we've had back. It was even cheaper than that a couple weeks ago.
Yeah, I mean, I think there's going to be a mini FOMO right now because people are going to wish that they bought a few weeks ago at lower valuations in tech to watch this dislocation, the dislocation between prices and earnings growth, finally close. So I wish I could say something dramatically different than the first two people have already said, but I can't because I think it's true. I think the trends that were in place pre-war are gone. The market trends that were in place pre-war are gone. The rotation probably not going to be what drives us because there are still domino effects that will happen because of the war. This was a larger supply shock than the 70s. It's big. And even if it only hits EM countries harder than anything else, there is a bake through of what will happen to U.S. growth. So I do expect a slowdown in U.S. growth, but that actually ends up being a tailwind for tech stocks. The one question mark is whether or not this actually creates sticky inflation going forward, and we have to get used to higher rates. We have to continue talking about the possibility of hikes sooner than we thought. That will pressure tech stocks as we go forward. But I think we're back to this.
That feels like
it's way out. It's way out right now. There's a very long lag. But I think we're back to this sort of befriend the tech bubble because it's going to keep inflating again. The fundamentals are intact, the optimism is intact, and frankly, it's operating in its own universe outside of the war.
Weiss, you agree with what everybody has had to say along the lines of, yes, you're going to hit new highs, we know, but what's going to get you to the next leg, and then the next leg, it's going to be back to tech and growth. You buy that story?
I believe so, and that's how I'm positioned. You know, the interesting thing about the market over the last decade is that it really seems to be, and I'm not going to tell you if I got actual, real strong evidence of this, it seems to be the battle of the old versus the new, where the old, meaning people have been around for a long time like us, you know, say, well, this is...
Speak for yourself. The new category, like the wall was right between you and Liz, all the way over to here, just in case anybody was wondering. But anyway,
look, apparently I like to give Liz credit for more experience than you do. But what I'd say is that the old
well-seasoned knowledge on
so the old typically responds to news and troubled warning signs ahead, you know, and reacts to it in terms of repositioning, going to cash, whereas the news says, you know what, that's an opportunity to buy. So we'll get through this because I've only seen V-shaped recovery since 2008. So I'm going to buy. And you know what? The latter cohort is right because markets go up 90% of the time. So if you can tolerate short-term instability, dislocation, you're fine. But what's a bit troubling is that all you have to do is show up in this market. You don't have to decide where you're going to position. You don't have to worry about anything.
You believe that? I feel like there's still people want to have the debate. I mean, I talk to enough investors and portfolio managers and market participants in general who come on the various shows and say, no, the broadening story is still intact, and they're believers in it, that, you know, people are not just saying, well, I'm just going to go now all in tech, and you don't really have to think about it.
I'm saying the other. I'm agreeing with you. I'm saying you just show up, you buy whatever strikes your fancy that particular time, and it's going to go up. They'll go up in different types of magnitudes, right? But it's all going to go up. And that's always troubling for the market. It's not troubling today, but if it continues with the lack of objectivity in terms of where you're going, what sectors, what you're focused on, then that particularly leads to too much froth. We're not even close to there. But if I were to say something that may worry me more so than rates, for example, because we've been able to tolerate rates to a large extent, partly because of productivity with AI, that would be it.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.